Hello, everybody. Chris Martinson here, and today we're going to be talking about finance and economics as part of Finance U. Remember, anything that you see in this video and all resources available at our websites or affiliated websites are not intended as or construed as financial advice. This is for educational purposes. Remember, if you have a financial decision, please consult a financial professional. We are not attorneys, we're not CPAs, we are not financial managers. As well, we do our best to be accurate, and everything we represent is as accurate as we know it to be. Now, let's turn to our program.
If you're the Harvard Endowment, just to pick a name that's familiar with folks, you can ask for more donations. You can, cut back on what you're sending out. You've got 1,000 years that you can wait for. But if you're 70 years old and you've retired and your life expectancy is 90, let's say that's the window, and you have a 50% decline in the market, it gets back to even another 50% decline. Well, you might not have enough money to last you over that 20-year retirement.
Hello, everyone. Welcome to this edition of Finance University. I'm your host, Chris Martinson. Today, we're going to be talking about the Treasury buyback program, also some creaking and popping sounds in the markets, what's going on with the Japanese yen, US 10-year not behaving, and Paul Kiker here to talk to us about what he's seeing in the markets that may suggest looking a little toppy. Paul, good to talk to you again.
Chris, always a pleasure.
Well, yeah, likewise. I've been very much on. Vibe has changed. Something's changed. Something's different in the air. I track what we call creaking, popping sounds, and I do want to talk about what this crazy Treasury buyback program, because a little wonky, but I think people need to know about it because it looks like desperation to me. It looks like a backdoor bailout. But before we go there, take a look at, if you would, this is the Japanese yen here, and let me get my little laser pointer out. I wonder what you're making of this. This was the run up here into 160, where it touched that 160 mark. And then this, everybody widely talks about, Paul. This was intervention number 1, cost like $30 billion. Intervention 2 cost about $30 billion according to sources. And then look, we're kind of I don't know. The market doesn't look too impressed with the interventions.
No, it
What do you
does.
make of that?
Well, it's interesting to me. So with that first spike, it looks like potentially that's a breakdown in the yen versus the dollar from that standpoint. Of course, chart being opposite there, weaker against the dollar. And that, with all of that intervention that's taken place in the interim period, it strikes me as kind of that you're standing in a pool of water, you're standing in the pool and you're holding a basketball down by your waist. And when you lose that and it starts to pop up, maybe you grab it a couple of times with your hand and you can keep it down there and you try to push it down, and then it looks like it's starting to slip out. So with that much intervention and we're creeping back up towards that price, it looks like, I don't know, someone made the comment, I can't give him credit, that the traders, the Japanese currency, the Japanese traders are the best currency traders on the face of the earth, right? Even the best can lose some plates every now and then. So it's certainly creaking and popping there, and concerning, because that's going to change the market environment pretty substantially if they let it get out of hand.
Well, sure. And the Japanese bank has been saying, well, we might have to dial back our purchases of the, bonds, government bonds. It was kind of weird because they are the bond market, It's like, I don't know, who else is going to buy? Like, Paul, can I interest you in some 10-year Japanese debt at 1%? I hope not.
I'm not into charity for somebody else's foolish behavior, right?
Yeah. What do they call it? That would be basically return-free risk. So it's an amazing thing.
So what other options, Chris, that you can think of that they have to kind of intervene if this gets out of hand? They're raise rates again, which is going to be interesting based on the currency trade.
They can't. So the last thing I read, which was admittedly like 6 years ago, so it's worse, had somebody calculated all the durations of everything and yada yada, and basically found out that the Japanese government is completely insolvent at an overall weighted average interest rate of 2.3% in their outstanding treasuries equivalents, Japanese government bonds, because that would consume 100% of all income taxes at that point in time, both personal and corporate. Yeah, you can always raise taxes, right? But that's kind of a hard limit. So they can't even get to 3%, 2.3. Then I bet it's lower to 2. I bet it's closer to 2 today, or even less. So let's say it's 2%. They can't go to 2%. If you can't go to 2% without blowing your country up, you don't have a lot of maneuvering room. You're on a bobsled run.
No, not at all. So they're running out of, and that's the concerning thing about it. I mean, especially as popular as the yen carry trade has been on Wall Street and as much profitability has been there. And then, you think back over time how our government celebrated or people counter with Japan's gotten away with what they've done for the longest period of time. And I'm sure that's crept into our government. So maybe this is coming to an end, and that has massive ramifications for every investor from a global perspective.
Yeah. Yeah, I do feel bad for the people of Japan, though, because I was just making this point on an interview I did with Lynette Zhang, which is I think they lost the plot line. Your money system is just there to serve the people, not the other way around. So the people of Japan are both aging and declining in number. So they don't need the Bank of Japan to furiously try and keep everything propped and get more debt and make sure that the stocks only go up. And because they're trying, what they're doing, Paul, they're managing, the money system now manages them. They're doing things they have to do because it's right to keep the system glued together, which you could sort of derivative argue, well, that's good for people. But you know what's going to happen to the people of Japan? So the yen at 157, that was like basically at 100 about a year ago. So it's lost a third of its value. So everything you import is now 33% more. I don't care if you hold it flat, right? So oil, cantaloupes, anything you're importing, that hurts the people. Now, didn't have to be this way, but this is I see these plate spinnings, as you said, like they're dropping plates. I'm seeing drop plates all over the place right now, and I feel bad for the people of Japan. But, well, to your question directly, how do they defend it? You have to sell dollars, U.S. dollar-based assets, and then you have to buy your own currency. That's how you defend it until you run out of dollar-based assets. What's a dollar-based asset? Oh, U.S. Treasury. Yeah, Chris, but if they were selling treasuries, we'd see yields going up in U.S. market. Uh-oh. Did you see the 10-year? Did you see the 10-year today?
Yeah.
Look at this yield just popping. I mean, that's a 45-degree slope right there. Almost no interruption.
And look at that gap there. That's intraday chart, right, Chris? So look at that gap. So who was it that, what caused that spike in gap to accelerate at that point?
Yeah, I don't know. I mean, that's pretty intense right there. So, so at 4.6, I just checked. I pulled this chart a few minutes ago, but that's this morning, I guess. But anyway, it's at 461 now. So it's just moving. It's just moving up. So that's what it would look like if Japan was, or anybody, somebody selling 10-year U.S. treasuries at this point. Yeah.
There's supply and demand. And what's interesting is you look at rates going up when I don't have all the data in front of me, but there have been several companies that have come out and, from food prices, and I think Target, if I remember correctly, one of the major retailers is cutting prices on some of the items. Now, I don't think this is outright deflationary at this point. This is just a resetting to the slowing economy and the average consumer that's really struggling. But, you've got prices being cut, but yields spiking. That doesn't match up right there. So they're, I guess we'll find out what's taking place here in a couple of weeks. That's one of the things I enjoy about watching price action is it gives you some indication early of events that will become headline news down the road.
Yeah. Yeah. That's why I watch the markets, because it gives me it used to give me a few months head start, and now I think it gives a few weeks, maybe a few hours, things are moving faster.
They are moving faster. And, I'm curious to see if the market, one of the things that I'm concerned about, well, I don't want to change the subject yet if you want to continue talking about that, because I do believe that that's a big deal in the Japanese yen. But, the market didn't react strongly to NVIDIA's earnings. NVIDIA has these blowout earnings, absolutely just magnificent what takes place. And of course, I look at the market today and NVIDIA, basically your Magnificent Seven are up and pretty much everything else is down. That's not the sign of a healthy market, right? Because, so So I don't like the price action in the market that's taken place after NVIDIA's earnings. So I've stated a couple of times, and I do reserve the right to change my opinion when the data changes. But I'm on basically top alert to watch right now because my expectation is just the euphoria, everything that's there that you see the markets run up into July. But I don't like that price action because you've got some extremes that are taking place. I haven't read Hussman's report that came out here today, his market alert, that there's some concerning things taking place under the surface. And the reality is where we are right now and what's taking place is a great indication that you're seeing a potential market top here. Now it's kind of a fool's errand. So I'm curious to see if we get some type of Fed talk over the next week or two to try to save the day and keep this momentum going forward, because for the past several years, they've been able to successfully talk their way into markets higher. November, hey, we're going to cut rates. Next path rates is lower. They seem desperate to cut rates up to this point in their conversation, but yet rates haven't come down. Markets run on that. Yeah, the economy's held up a little bit better, but that popping and creaking is starting to come into, snapping as well of the consumer and areas around the edge. It's getting louder and louder. So curious to see how this unfolds, but we're basically on top watch right now. Not calling for one because nobody's going to be able to pick the top, but I am seeing signs and undercurrents under the market. And, it's not that often John Hussman puts out, a major alert, and he's usually very good when he puts those alerts out. I really like his work.
Yeah. A lot of divergences, as they say, in the market. One of them I noticed is that the wonky time. So for anybody who's doesn't like wonky stuff, the RSI has been declining on the overall financials, the index. Even as it's been powering higher. That's called a divergence, right? Normally they go up together. So with one going down and one going up, it's just anyway, I trust the RSI. The momentum's been flagging, even though you have this last gap towards the top. But you want it, Paul, I'm old enough to remember. And I did a whole thing on the crash course about bubbles, and I noted that usually there was at least a generation, right? Granddad lost everything on tulip bulbs. You avoid making those mistakes again because the lessons were painful.
Yes.
Swampland takes a while to, forget about that and get back into swampland. So the Fed, though, because they blew a serial set of bubbles, right? We had the internet bubble and then a housing bubble and then a this, and now we're in the everything bubble, right? So people forget.
Mm-hmm.
But I'm here for everybody watching. I'm going to show you prima facie, 100% guaranteed evidence that you are in a bubble. You ready? Apparently, since you mentioned it, NVIDIA, Paul, is worth more than all the publicly listed German companies combined.
So that's official now. Look how quickly that happened. That's amazing. That's amazing.
Lol, right? No, it's not. It's not. It's not. It's not.
But Chris, the future's AI, but everything's going into semiconductors, but they're innovation.
Eyeballs. Yeah. They're not making more land anymore. The Augustus Semper bulb is one of a kind. I know the stories, Paul. I do.
Right. Yeah. That's one of the things Husband talks about in there is just the fact that, it's not different this time. I mean, that's what every bubble has in common throughout history is it's different this time. You go back to GE, and there's probably somebody that retired from GE in the late 1990s when that was the single best performing stock, and Jack Welch, it was, if I remember correctly, was celebrated, and he's, they're following everything that Jack Welch did over that period of time. And here we are, 24 years later, and it's substantially below, and the company's split up and all kinds of troubles. And so, that's amazing because one thing the Germans can do, at least historically, is produce really good things. That's amazing. It's larger than the entire German economy.
Yeah, isn't that? Anyway. It's not worth more than the entire German economy.
No, but that's what manias and that's what the fear of missing out does. And sometimes I wonder if it's after that, the pandemic, that attitude that people are like, one of the advertisements that was in the North Georgia area that the real estate agent says one of the best advertisements they've ever had is life is short, buy that second home, right? So, we seem to have a lot of that mentality, and the Feds further fueled that with stepping in and bailing the market every time. So So those that are paying attention to fundamentals, every time that they've been punished for making prudent decisions, they've been punished for having disciplined decisions, and people have been rewarded for being, fiscally responsible, right? And irresponsible, and it takes place. So, but that's how you're successful in the long term, is discipline and patience and integrity. That's what stands the test of time. Short-term manipulation always gives way. And the question is are we at the peak of that short-term manipulation? And is the pain of that getting ready to be experienced by, unfortunately, too many investors out there that have, I think it's Jordan Peterson says, if you abdicate your responsibility, you'll abdicate it to an eventual totalitarian. Now I'm butchering that, but he said it enough times over the past, in the talks. I keep thinking, okay, we work with professionals. I abdicate my tax returns to a professional and I hire them. We're on the same page, because I don't enjoy doing tax returns, and I'll get myself in a lot of trouble if I do those. So I hire a professional to do that. There are some people, if I enjoyed doing tax returns, I could. But my great concern is here you are where investors believe that abdicating their money management to a passive index in this environment I don't believe is going to be a good thing. I think we're going to look back and say, hey, that was a great tool to be used by investors, but passive investing in environments like this is not the best way to go. You want to buy it. You want to have a good investment strategy and follow it for the long term and understand its strengths and weaknesses. So I'm concerned that those that think that something comes easy always is going to learn a hard lesson by the time this cycle is over.
Well, the thing that has me worried, Paul, is the mental trap that the Fed has put people in, right? Mm-hmm. Because when I talk to people, there's two things I hear very commonly. One, they're concerned about losing what they have. Mm-hmm. Right? That's probably number one concern, is like, I just don't want to lose what I've got, right? So they're sort of in wealth preservation mode. But the second thing I hear a lot of is, well, if the market really starts to fall, the Fed will bail it out, right? And it's kind of it's probably, if you're playing the odds, that's what's just happened. The road's been straight the whole time, so I'm predicting it's still going to be straight, even though I can't see it, right? And we hope that's true, but every so often the Fed just backs up and that thing falls, right? And so I'm worried that there's an entire full generation of people who've never seen an actual market that wasn't under complete Fed control, right? But I think there's signs now that they're losing that control, because it's a multipolar world now. The BRICS are coming on board, as we talked about last week. They have this thing called the unit, which is going to be a gold-backed, at least in part, trading currency unit, which is now going to be in direct competition with the world's reserve currency. The dollar's unbacked, the unit's backed. Guess what? If people have a choice, they're going to wander away from the dollar. Oh, how many dollars are out there? We don't know. Could be trillions, could be tens of trillions. We're not sure. We wish we'd been keeping track, right? And so that could create a lot of inflation, right? So to the extent people believe the Fed can bail this market out, one, they might be right that the Fed wants to, but where they might be wrong is they might not be able to.
Right. That's my concern. When I look back and just observe, okay, what happened in the past? How was the Fed so successful in being able to bail out the markets? You had interest rates peaked in early 80s. They've been heading down for quite some time. You had a generation in the late 70s, early 80s that were really scared to death because of what happened during the Great Depression. Well, people are not scared of debt anymore. So you had individuals that were running these large corporations. Then you look at the success as interest rates had gone down, and the financialization that Jack Welch was able to undertake in GE, and how that just skyrocketed that stock price, right? And then interest rates continued to go down. And the Federal Reserve continued to put more effort into supporting the economy. And I'm thinking about showing a chart here in a minute that goes back and shows price to earnings ratios, but I'll have to step through it in just a second. But all of that's reached a point where now what can they do? I mean, inflation's still really, really sticky. And, my son came up to me the other day And I completely misread this, but this is a college kid, right? So some college kids are broke, but this is what they're talking about. He said, "Hey, Dad, did you realize that obesity rates have dropped dramatically under this administration?" And so I'm immediately going to Ozempic, right? I'm like, "Yeah, seriously." And he said, "Dad, you're being too serious. Nobody can afford food anymore. It's a joke," right? And I thought, well, that's a joke that's about true. So the problem is how can they intervene in the way that they have done in the past without risking inflation getting out of control? And, and that's something that nearly every person that I talk to is experiencing and feeling in their personal situation right now. I mean, even Holly and I just went, the two of us, and ordered fast food this weekend from a place that she really wanted to order. We do it about once every 9 months. Shouldn't have done it. Didn't feel great at the end of the day. But, her comment was, we used to could stop here and feed a family of 5 with 2 teenage boys for the price that just the 2 of us ate today. So, it seems that we've reached the point of diminishing returns, and if maybe they can keep this up a little bit longer, but eventually we're going to reach a point where something breaks. And, the question is how quickly do things break? And when you look at historical valuations and where the market is right now, I pay very close attention when you start seeing the undercurrent of the market, when the blood work, this is just initially, but you're starting to see the blood work not look good. And any good doctor out there is going to pay attention to your blood work. And if that blood work starts getting out of whack, they're going to start asking questions and paying a little bit more attention, which is what we're doing daily right now in the portfolios because of what's taking place under the surface of the market.
Well, I'm curious about that. So if you trust Husband and or your own models and your own experience, and you decide it's time to lighten up, what is that process for you? How do you come to that decision? What do you do?
So one of the things we have to gauge is looking at individual clients, right? Like some clients have a little bit higher ability to tolerate volatility. So from where we are right today, I calculated, I'm looking at it. So before we get an absolute hard, completely exit the markets, before our other indicators turn, because one of the problems with a lot of the indicators that you have out there that you can choose across the board, you have to apply them consistently, and you have to use a weight of the evidence, and you have to adapt. That's one thing I like about Husband so much, and I just respect him greatly, is because he's not too proud to adapt, right? And the Fed's made people adapt. But you pay attention to these indicators. So one of them's about 12% below where it is right now. But then there's some other that are a little bit closer for clients that are more concerned about preserving capital. Those clients we can move a lot quicker, which are pretty close to where we are here. So, we tend to wait to get a really hard defensive stance until we have some more indication, because this is just the first indication under the market, and maybe a tremor. It may be a birth pain, right? But what we see is those birth pains, contractions go from, this is a horrible analogy, but I'm going to go with it because I started, but those birth pain contractions go from 5 minutes to 3 minutes to, it's been 21 years since I've had a kid, so I can't remember how quickly they come together, but, ultimately you have a birth that takes place. And so we're starting to see some contractions under there. And that means that, when I'm looking right now, Treasury yields are going up. So I can't go buy a 5-year or 10-year Treasury. Okay, where am I going to go for safety? I don't want to buy a 5 or 10-year Treasury. In the past, it's like, hey, we'll buy the 20-year Treasury because market's going to go down, Fed's going to cut rates, and then those bonds will go up in value. The first time we didn't really pile into longer-term Treasuries was really in the 2022 pullback, because the only thing that looked relatively decent was money market. And in this environment, I don't want to have corporate money market. I want to have Treasury only money market, because technically that's the safest thing that you can own as a U.S. investor, because it's carried back by the full faith and credit of our government. And I know people are chuckling out there, but from our standpoint, that's the safest thing that you can own as a U.S. citizen. And then 2, be ready. I like to look at gold and silver prices, especially if we've got somebody that we're averaging into, because typically when there's a major sell-off in the market, even gold and silver prices are going to go down. So I'm not saying you go sell those, because I like them from a long-term standpoint if you own them, but you transition into averaging into those prices as time goes along if you're picking that up, because I'm not worried about picking the bottom, right? But if you go back to 2007, 2008, gold went to $1,000, and then at the worst part of the sell-off, it dropped to neighborhood of $675-700, and then it shot to 2012 up to 1,800. So we look for and build our list and shift into principal protection. So what that looks like where we are right now, Treasury only money market would be the safe haven to be in, because if yields are spiking and the market's going down, we repeat a scenario of what happened in 2022. But if we're headed into a recession in that environment, right, then that could be much greater than what we saw in 2022. I don't know that that's going to unfold, but right now when I look, Treasury only money market. So we're looking for the safest, highest yielding place that we can go when we exit equities. That's a really long-winded answer to your question, but hopefully it makes sense.
I'm glad you're looking out for everybody that way, because this wouldn't just sort of be a top. I mean, there's a chance that this could conspire into a heck of a situation, because we've got messes just pretty much everywhere at this point. So I see them sticking their fingers in the dike, and spinning plates and whatever our metaphors are. Paul, I just want to talk about this because somebody asked me to cover this in Twitter a while ago, and I said I would, which is this idea of these Treasury buyback operations. Okay, so the U.S. Treasury is in the business of buying back out of the open market Treasuries. You're going to love this story. So here they are. They say the operation type is, let me get my pointer out here. So here on 5/28, right? Operation date 5/29. Hey, that's today. At 1:40 to 2 p.m., they're accepting bids. It's called liquidity support. They're anywhere from a 1 month to a 2 year. So they got a bunch of maturities out there that they're going to be offering today, right? And $2 billion. Next week, now they're doing 20 to 30 year bonds. They're buying them back. Okay. Again, $2 billion. So it looks like around $2 billion a week. And they're going to be buying, mostly these are all long dated stuff. Well, 7.5 years, 5 to 7 years, 10 to 20 years, tips. All that, right? Okay. Wait a minute. Why are they buying these things back? So I went to the site, of course, Treasury Direct, straight from the horse's mouth. Why does Treasury buy back Treasury marketable securities? Oh, that's a good question. Why is that? Purpose. Why do they do this? Well, 2 reasons. Cash management buybacks are intended to reduce volatility in Treasury's cash balance. What? Volatility in their cash balance? What do you mean? The Treasury has a cash management problem, Paul, the same way a coke addict has a cocaine management problem.
Well said.
The money just goes out the door. There's no volatility. I can't, how do they say this with a straight face? It's intended to reduce volatility in their cash balance. Paul, they don't have volatility. They auction some paper off, they get some cash in, and then they spend it.
Yeah.
A big blob comes in and it trickles out or floods out. Blob comes in and it floods out. Blob in, flood out. That's the whole thing. So they're saying that's one of the reasons. Second reason is liquidity support buybacks are intended to bolster market liquidity by establishing a regular and predictable opportunity for market participants to sell off the run Treasury securities. Ding, 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 ding. We have a winner. They're saying, there's some off-the-run Treasuries out there that aren't selling so good right now. And so somebody has to step in and buy them. And apparently it's about $2 billion a week, but that's sort of a rough number. They could go higher, could go lower. But what are these off-the-run Treasuries that they're saying they have a problem with? So I dug around. You know me, Paul. So I keep digging. This is from April 16th. Here was one of their buyback announcements. This was one, they were doing a 10 to 30 years here. So they're hoovering back up 10 to 30 year paper, right? 200 million. This is when they were first like, well, let's try it out back in April. They're like, how does this work? So, working out the kinks. What did they buy back? Look at this. I found the CUSIPs, Paul. They were buying back stuff that had coupon rates of between 0.125% with a high of, looks like, 2.15%, 2.125, 2.125%. And you can look at all these maturities. This is long dated paper. So, Paul. That would be like me having a mortgage at 2% and saying, I'm gonna sell that. I want to re-up that with a mortgage at 6%. Yeah. Nobody does that. They're buying back, Paul. They're stepping into the market and buying back their cheapest debt, stuff they should have issued by the absolute bushel when they had the chance, but instead they're stepping in using my tax dollars and yours to buy back this paper that they have to pay minimal interest on. And because they do have a cash management problem, and it's always going away, they're going to have to replace that probably with short dated paper, because I know my government, and it's going to be yielding 5.4%. It's going to be twice to 3 times to, if it's 0.125, what is that? 8 times, so 40 times more expensive from an interest standpoint. They're going to be absolutely skyrocketing their interest payments at a time when they're already spiking. What do you think of that?
That is absolutely foolish. And the first graph that you put up there that explained what their objective was, it stated in there, reduce borrowing costs over time. So in what world does it make sense? In that second paragraph, reduce borrowing costs over time. In what world does it make sense to refinance 0.21 to 2% and lock it in at 5.4? That's just egregious, and that's no respect for the hard work that American citizens puts in to pay the tax dollars that they pay. You know, many people work 3-4 months a year just to pay their federal income tax, and that's egregious. That's criminal, actually.
Well, it is. So I when I first heard about these buyback programs, it was told to me by my broker back in the day, 30 years ago. He said, "Hey, there's a risk. You know, you got some 10-year 7.5% paper. If rates continue to go down, the government has the right to come and take that paper off of you, because that would reduce their interest payments over time, because they would retire my 7.5 paper, and then they would be replacing it with 5% paper or whatever the rates were at the time. And that would make sense." Paul, they're taking stuff that they were literally was out the door with a 1/8 of 1% interest rate, and they're hoovering that up, a couple billion a week, taking that back and replacing it with 5% paper or
all
more.
at the same time that our national debt's increasing at, what is it, $1 trillion every approximately 100 days, if I remember correctly, Chris.
Yeah.
And that's one way they could reduce the acceleration of that debt.
Yeah. You know what this is? This is a stealth bank bailout. Remember, you saw those FDIC charts that showed those mark-to-market losses? All the banks are sitting on these huge what's a mark-to-market loss at the bank? Well, that's a bank that, because the Fed in its infinite wisdom decided to cram interest rates down to, when it got down to all the way down to like 0.5% on 10-year paper, and they have to put their excess reserves into treasuries. Well, now they had to buy some of that half percent 10-year crap, right? They bought that. Now, 10 years are at 4.6. So if they had to sell that 0.5% yielding piece of paper, they'd be taking probably a 20, 30, maybe 40% loss, depending on how much time's left on that.
That's right.
So it's a huge loss for them. Oh, good news. Government bought it off my books. It's gone. I don't have that. And so what I can't find, this is, you know what, I scoured hard. You know what I want to know? I want to know what price they paid for these.
Oh, because I would love to know that price.
Yeah. Explain to people what would, I mean, why is the price relevant here? I think people need to know this.
Okay, so price matters. All right, everybody picture a seesaw on the playground. Some of you may not be old enough to remember a seesaw. I don't think they have them anymore. But on one side, you have interest rates, and on the other side that you have value. So let's say you pay $100,000 for a 20-year treasury that's paying you 2%, okay? Now, if interest rates go to 5, and Chris, I can't calculate off the top of my head the percentage drop. Let's just say it's 20%. So if interest rates go to 5%, the other side of that seesaw drops, okay? Now, here's the reason why. That drops so that yield to maturity is 5%. So there's, a lot of you might have pay your kid, if hopefully you wouldn't bail them out because they've got to learn to be tough. But, if you got a kid that's doing the right things, they get in a bind. Maybe you'll be generous to your child and settle for 2%, right? But nobody's going to go on the market and settle for 2% when you can get 5% for your money just to somebody that they don't know. So that's why that bond drops in value. And if interest rates stay where they are, it'll mature at $100,000 in the future, but the buyer is going to get that $2,000 per year that's generated on that $100,000. And at maturity, they're going to get the difference in that $20,000, which gives their yield to 5%. So that's the problem. It's one of the reasons why Silicon Valley Bank went under, is because they acted foolishly. They tried to maximize yield in the short run, thinking that interest rates were going to stay low forever. I can't say exactly what their motivation was, but they carried excess risk by reaching out on that yield curve to try to maximize their return. And then interest rates spiked and it wiped them out. So, if Chris, that didn't cross my mind until you said that. So, I made the comment that it was criminal from a fiduciary standpoint to the taxpayer, but think about what that does. If they're buying those things at par, not par, yeah, at issuance value, right? They're paying $100,000 for a bond that really should be worth 80. That means the same taxpayer that the mark to market requirement for on the book loans and house values and the banks that took so many banks down in 2008, those banks that survived because the individuals got taken down in that mark to market for house loans. I hope I'm explaining that in the correct manner because my mind's going here, are having to pay extra from taxpayer dollars to bail out those banks for political purposes. If that's the case, I hope you can find that because I'd love to know what they're paying for them.
Well, you could hear the government logic, which is like, well, we issued it at par, so we'll buy it back at par.
Right.
That's fair. But instead, out here in the open market, that bond is worth 80 cents on the dollar, but the government's going to pay 100 cents on the dollar. And of course, that bails out the bank, right? Mm-hmm. So I could see that happening. And the second thing, of course, we would deserve transparency would be, they're going to get a lot of bids. Like a bunch of people are going to say, take my paper, Yeah. And the government will select. What's the selection process? Which ones are they taking? Oh, surprise. They all came from JP Morgan, right? And, thank you, taxpayers. Maybe we have another because that's the whole thing. But this, regardless of the shenanigans that might happen, Paul, the Treasury, this is unprecedented. In my experience, I know of no other period where they are stepping in to buy paper because they say, they have to support the liquidity operations where they're buying off cheaper paper to replace it with more expensive paper.
Right.
I've never heard of this.
No.
Maybe I'm just missing something, but
that doesn't make sense. And just to put it, because it is a complicated subject, but just to simplify it for individuals, think of it like this. You have a friend that's got a 30-year mortgage locked in at 2.5%. And they come to you and they, in a midlife crisis and they're saying, hey, I want a Corvette so bad that I can't stand it. I'm going to refinance the house, but the mortgage company's telling me I have to refinance the whole thing. I can't do a line of credit. So I'm going to go from 2.5% to 7.5% so I can buy a depreciating asset. None of us would advise a friend to do that. And quite frankly, we'd say, are you losing your mind? That's no different if they're refinancing that 30-year debt. That's an opportunity of a lifetime for our government to basically, take advantage of those low interest rates when interest rates are higher and be responsible for not putting us in a position where we're having to refinance that at 5.4%. That doesn't make sense at all.
No, it doesn't. And that would be like saying, hey, I bought these shares of this company and I paid $10,000. They're worth $8,000. Paul, you're the government. Could you help me out? Could you just buy them for $10,000 from me? That would be great. Thanks.
Yeah. That's another perfect analogy. I'd say, Chris, sorry, bud. I got a responsibility to all those people that I'm taking care of that are paying me their hard-earned dollars. You got to figure that out. But that doesn't seem to be what's taking place right now. If they're paying par.
But another finger in the dike, and we're watching this creaking and popping going on here. So very odd, bizarre thing. And of course, it's all being headed up by Janet Yellen, who, again, every time I hear her speak, Paul, I renew my passport. I'm like, you never know. She does not instill me with confidence.
That's funny. No, not at all. And, and very political in stance, which concerns me in that position, quite frankly. I was trying to say, one of the things I kind of wanted to point out, and I don't know if this will work. Let's try it here. What I want to share is a chart of the S&P 500 going back to 1926. And it shows an overpriced market, a fairly priced market, and an underpriced market, and how that cycles. So let's try this and just see. So if you guys can't see everything because there's a lot on this chart, just bear with me. I'll try to talk you through it. So let me get into my window. There we go. Can you see that there, Chris?
I can.
Okay.
Yep.
So basically what this is on the left-hand side of the chart, we go back to, I believe it's 1926 is where it starts. Now, the black line is the S&P 500 up until today. And there's some red dotted lines that are real small. I know they're hard to see, but a red line is a price to earnings ratio of 20, which is historically considered expensive. The blue line is a price to earnings ratio of 15, which is fairly priced. And then the green line is a price to earnings ratio of 10. You don't see that very often historically, but that's an unbelievable investment opportunity to really take the big picture into context, because that means you're buying companies at ridiculously depressed prices. So back here, you can see we got up towards that high end right before the Great Depression occurred. You had that massive market decline. So by the time that was over, you got down towards a cheap market. That was a time that you wanted to be aggressive in buying. We came out, you had another decline that dropped into 1942. And if I remember correctly, the market bottomed the day Pearl Harbor was bombed. So, of course, it was closed and open, but that was the point that the market bottomed. But it was very cheap relative to the earnings of the company, because you want to buy low and sell high. Now, after World War II, we get up towards this higher level, and the market starts to have a little bit of wobbling, and then has the major decline when inflation accelerated. So when you see that red line and the blue line, inflation accelerated, so corporate earnings went up, but the market went down. That was the last great buying opportunity, and that lasted for about 10 years, till about 1984. So what I wanted to point out is, here we are at this period of time. We set the record back in the year 2000 from an expensive market, because that euphoria in the 1990s and interest rates lowering just supercharged, our markets, and you were way above expensive. So markets sell off, and then what did Greenspan do? They cut interest rates and intervene, which led to the housing bubble, but the market stayed expensive. And then you had 2008, you had these super interventions. And every time we've wobbled, they continued to try to keep this market higher with greater interventions, but this market has stayed expensive. And I believe that's made investors complacent. But the point that I'm making is I do believe that by the time this cycle is over, if this is the top, we're going to be closer to a 1974, 73, 74, 73 decline, where we might see normal valuations. And that's the reason why we believe it's so important to protect your capital if you start to see the undercurrent of the market come apart. Play the game by the rules that are forced upon us, but stay as close as we can to the exit. So that's one thing that I just keep thinking about how much intervention they're putting in here, and how many plates they're trying to keep spinning, and how much creaking and popping is leading to snapping. And you take into consideration, what I would say the final nail in the coffin would be the Magnificent Seven countdown, to where those stocks start to fail at some point. NVIDIA may be the last one standing by the time it's over. That's a long way down. I mean, just to get the fairly valued on the S&P right now, you're talking about 1924, and we're at 5277 right now. That's a substantial decline, and that's one of the reasons why I believe risk management is so important, and that we have to be diligent where we are right now, because we don't know where the top is, but the downside risk of where we are right now, if these things come apart, if they can't kick this can down the road 3 or 4 more years, is life-changing for a whole generation of baby boomers that are relatively aggressively invested right now. And I don't blame them. I'm not saying 20-year treasuries is the answer right now, because you could have an inflationary surge that causes bonds and stocks to go down at the same time again. So this is a challenging environment. It's a dangerous environment for investors, especially the ones that are passive.
Well, this time is different. Foremost dangerous words. Can you pull that chart up? Because I got 2 observations about that chart.
Yes.
The first is that if you look at that peak in 1929, and that's a nominal price chart, if I understand, it's not inflation adjusted. So if we're looking at that chart,
it's nominal.
Yeah, if you took that first peak there all the way over on the left, right? How many years before you broke even, just in not including inflation, right? I believe it's 54 years, if I remember my dates right. So you just draw that little, you take your cursor and you go horizontally straight across. You go a long way to get back to even, right?
Yeah, that takes you all the way. I can't read that with my contacts on 1956 from that peak, right? What we're looking
Yeah.
at. So now I actually have some other charts that'll kind of break that down in there. And let me see if I can pull this
Well,
up.
hold on. But before we go
Oops,
there, because you'll see the same thing like in 2000, that 2000 peak, same thing. So when you get to
yeah,
those major peaks, point is it just takes a long time just to get back to sort of even, you know?
it does. It does.
Right? And some of us don't have 20 years to get back to even, right? That's not an acceptable way to run this. But the second thing is if you just sort of eyeball this, you'll see that you could draw a pretty straight line there from that low in 1930-ish. And it's a straight line. Now, the right axis of this is a log chart. So a straight line on a log chart means that it's been growing exponentially. And I would, in my other work in the world, Paul, you can do that if you understand what's actually driving the growth of an economy. And what drives it is obviously, you got some productivity improvements, you got technology, but it's energy under all of that. So every single moment of this chart has been under a regime where we had access to as much oil as we wanted. And all my data says that that would be a wholly unfair sort of an assumption to apply for the next 20 years, right? So it's a really big shift. Like this is great. I love being grounded in the last 100 plus years, but I don't think the next period of time is going to be the same for all sorts of reasons. $100 trillion of debt right now. We're no longer a net exporter because we are now a net import dependent nation here in the United States, to be very US specific about this. We obviously don't have the energy situation we used to have. Maybe there's something at Area 51. I don't know. Maybe there's free energy and they've just been suppressing it. Maybe you can make a carburetor run on water. I don't think so. But these things are, but that's, I think people have to begin factoring in the answer to this. Where is this growth going to come from? And right now they're saying, oh, AI. Now, listen, AI could make a lot of things a lot more efficient. Is it a better thing for our country if we don't need 5 million lawyers, which is how many we got now? AI can do most of that. We need 1 million lawyers. So don't need 4 million lawyers. Not picking on lawyers alone, right? Just saying that sounds like a good thing from the consumer side, but it's not a good thing from the lawyer side, right?
No.
When I look at AI, Paul, is this thing that's going to make us wildly more efficient and better. What I really see is one of the greatest job de-working programs that could ever come along, and nobody's telling me how we're gonna square that circle, right?
No. I mean, you think about where AI is. Artificial intelligence, robotics that comes along. There's and I've thought. I mean, there's companies that have bricklaying robotics right now. Now they're not perfected, but as artificial intelligence continues and advancements, that's job
it's coming.
construction. I mean, we're already going and checking ourselves out at the grocery store, and what Amazon's had was an Amazon somewhere they've toyed with the idea of you walk in, it scans your face, and you pick up whatever you want. And it charges you when you walk out of a grocery store. I mean, that essentially means those are less jobs that are there. So. And technology is inherently deflationary. It makes things more efficient, which reduces the cost. So, the story just doesn't add up when you really look at it, the view from 30,000 feet. You can get caught up in the narrative and the greed of, hey, my NVIDIA stock's going up and having something to brag about at a cocktail party is really good, but that's about all it's good for in the short run. From a holistic economic perspective.
So I don't see AI as an unmitigated good that's just going to lead to a lot of economic growth. I see it as a mixed bag, right? It giveth and it taketh away, right? At the same time. So leaving that aside, well then, great. Where's this growth going to come from? What is it, right?
Right.
What is it? Better homes in gardens? Is it boats?
A lot of growth and growing your own. But I mean, the thing is with capital being cheap, I mean, you look at, I used to do a lot of water skiing historically and competed in that, everybody who wants a boat can get a
slalom
boat.
through the buoys kind of a thing on a timed course.
I did. That's what I did. So my wife and I met in college and on the water ski team and that was something I loved doing for a period of time. So I won several awards and The interesting thing is, had it been golf, I would have made an unbelievable living at it. But, the water skiing community's got a phenomenal number of people in there, but that's what I did. Did it all the way through college. But, paying attention to today is boats are easy to get. I was shocked when I went down to the boat show, several years ago, because I left the water skiing in 1997 when Holly and I got married. And, I was amazed that you can get a 30-year loan on a boat, right? And, but stretching out the ability to pay makes it available to the average individual. So I don't think every single person it's appropriate to have a boat for, but most people that want to have one have had the ability to get it because of easy credit and low interest rates. So I don't think the growth is going to come from ski boats.
Well, yeah, and then of course you need a lot of energy to pull off any kind of growth, AI or otherwise. I mean, this is the dark side of AI right now, Paul. I'm seeing reports now where they're starting to square up to the idea that these data centers that they want to build, they just can't. You don't put a data center in, because some of them consume as much electricity as a small city, right? So some of them come with their own dedicated nuclear plants. Some of them are parked next to stranded gas fields. Some of them are parked next to hydro plants or something. But that if you calculate, like, the assumptions built into NVIDIA's earnings growth include the idea that we're going to put 100% of our energy into data centers in the next couple of decades, right? It's probably not going to happen. Just going out on a limb on that one. we're gonna want some of that electricity for something other than a quirky response on a chat.
Yeah.
Just saying.
Well, and that kind of brings me to mind. Let's see if I've got this. I was trying to look. You pointed out the fact that the market went sideways for a period of time.
Yeah.
I thought I had the charts in here. It's 25 years to get back to even. I don't have them where I can show them easy enough, but I'll have them one of these days. But you're right. We've reached this point where I think you've hit maximum efficiency, and something has to give, and things are going to change, and it's going to take quite some time. During the Great Depression, it was 25 years for the market to reach nominal new highs, not counting inflation adjusted. From 2000, it was 2014 before you hit highs. From 1968, it was or 1982. Yeah, you hit new highs in 1973, but you didn't sustain them again until 1982. So my concern is you're going to have a lot of individuals that, unfortunately, and have operated off of modern portfolio theory that was developed by Harry Markowitz in the 1950s, really for institutions. And it makes sense if you have 1,000-year time horizon, right? Set it on the shelf, forget it. If you're the Harvard Endowment, just to pick a name that's familiar with folks, you can ask for more donations. You can, cut back on what you're sending out. You've got 1,000 years that you can wait for. But if you're 70 years old and you've retired and your life expectancy is 90, let's say that's the window, and you have a 50% decline in the market, it gets back to even and another 50% decline. Well, you might not have enough money to last you over that 20-year in retirement. That's why it's so important to have a risk managed strategy, because when you're in the distribution phase of your life, when you're in retirement, that decline can absolutely wipe you out. So if you're too aggressively invested because of Tina, there is no alternative, right? Hey, market's going up. The Fed's going to bail us out. Instead of getting 1% on the CD, why don't I chase the market? Hey, that's work. That's hindsight bias. Okay, well, great. You've put 100% of your faith into the Fed. And the only thing that I would ask is, really look at some of the decisions our political leaders are making, and do those really make sense to you on both sides combined, right? And so that's where you're putting your faith in, because if you've got $1 million and you're drawing 50,000 a year off of it, and you drop 50%, well, guess what? Now that 50,000 a year is 10% of that account balance. And I know this is an extreme analogy, but it's the reality for a lot of people. They're just too aggressively invested without a risk management strategy. So now if the market makes 10% a year for the next 10 years, well, you're making enough to cover the income need that you have in retirement, but another market decline will wipe you out, right? So that's why the 2000 decline and then the 2008 decline just dramatically upended the lives of a lot of retirees. So that's my concern about what'll happen if they can't successfully kick this can down the road. It's going to completely upend the lives of a lot of individuals, because when you get into retirement, there's no do-over, right? Like, it's not like college. You can't go borrow money to get through retirement. You might can do a reverse mortgage as a last line of defense, but that's a last line of defense, and something that you hope that you'll never have to get into. So that's why it's so important, why we spend so much time doing the retirement planning and pointing out to people and showing, hey, can you afford a 50% decline in retirement? If you can, great. You don't have to worry about risk management, but you at least need to know the strengths and the weaknesses of the path that you're headed towards. The path in front of you.
Yeah, excellent. Well said. And we're going to leave it there for today. So for anybody who wants to have a discussion with Paul and his amazing team to discuss your portfolio, no obligation, go to peakfinancialinvesting.com. You've seen the crawler going across the bottom. And as well, Paul, we're going to be seeing you in a few weeks at the webinar, Protect Your Wealth, where we're talking about the great taking and how to protect yourself from the great taking. Complicated topic, worth it. Anybody, everybody who has wealth or money to protect, or even those who manage it, really need to spend some time on this and wrestle with it. So looking forward to that with you as well.
Me too, Chris.
And
looking forward to it.
And I just hope whatever storms y'all have been having down there, you keep them or send them out to sea. Okay.
So far, we've been fortunate, but there have been some major storms in this area. So hopefully they will not head in your direction. Hopefully we don't get any more either.
Yeah. Nick's been playing pickup sticks on his driveway with trees and all that. So quite the adventure down there. All right. Well, till next week, Paul. Thanks so much for your time today.
Thank you, Chris. Have a wonderful week.
You too. Hello, Chris Martinson. I'm the CEO of Peak Prosperity and also Peak Financial Investing. And after watching that, you're probably wondering, well, what do I do with my money? Look, you both deserve and need somebody who can talk to you about what's really going on in this world, understand the situation as it is, not be steering you towards certain things that don't make sense for you or just keep you in a game that's already ended. Look, if you want to talk to somebody about the petrodollar declining or what is happening with gold or which sectors are actually the best ones to be in, given what the Federal Reserve is up to or the federal government, you deserve to talk to somebody who can answer those and has a few gray hairs and has been there through some of the economic cycles because, hey, we're in another economic cycle, so it's good to have that experience. Fortunately, at Peak Financial Investing, what we do is we go out and we scour and we look for the very best firms out there who satisfy one thing above all else. They've got great experience coupled to great customer service. So if you want to come by peakfinancialinvesting.com, there's a very simple form you can fill out, just a few fields. You hit send. What happens is an email gets triggered out. It goes to an endorsed firm of ours. You will get an email back. You can then set up a phone call for a 30 to 45 minute free, no obligation, no pressure call to find out if this firm is a good fit for you and to find out if you're a good fit for the firm. It has to go both ways. And if all that matches up, this will be one of the best things that could happen to you this year. So please come by peakfinancialinvesting.com. Very simple process. We would love to help you if we can. Thanks very much.